Hey, Mark, really good to see you. Today, I want to ask, is the bear market over? I'm asking because the S&P 500 recently climbed more than 20% from a 2022 low. Here's what that looks like. The markets have certainly been on an upswing, but I'd like to know, how do you define a bull market? Because I'm seeing some experts who follow that 20% rule, but others consider it to be a false signal. Which metrics are you looking for?
Well, Aaron, it's really great to see you again, and thank you so much for having me.
Mhm.
It's kind of interesting because by definition, being up 20% on the upside, you would conclude that, yeah, we are firmly entrenched into a bull market or a rising market. And we've obviously seen that. Contrary, when we're down 20%, we would define that as the beginning of a bear market. In fact, last year we touched minus 25%. But I think you have to look a little bit deeper, a little bit more under the cover to really see what's going on, because really what's driving all of the returns right now, and it was on the back of this idea of artificial intelligence. So ultimately, what we see a small part of the economy driving all of the returns right now. So with that being said, I can't really say, hey, we're entrenched into this bull market. And yeah, we haven't seen absolute new highs yet. So when we see those things, then I think we can kind of say firmly, yes, we will be in a bull market. But as of right now, I would say no, we're not quite there yet.
Okay, I'm glad you brought this up because I do want everybody to see what this looks like. This is a look at the S&P 500 year-to-date performance, and the rally has been led by that small group of tech stocks that you mentioned, propelled by artificial intelligence. Well, the average individual stock, though, in the S&P has risen less than 3% this year. So for those who believe the bear market is over, are they missing the bigger picture?
Well, I think so to some degree, and it doesn't mean that these stocks can't continue to perform, because there's a tremendous amount of momentum that's
Hmm.
driving them upward. But as we're seeing, like this week, we're seeing a pullback in a number of these stocks, which it makes sense because they've risen so fast and so quickly. But I think what we really need to focus on is the underlying participation of the broader economy. And really, the broader economy is telling us that things are weakening, demand is weakening, and on the back of these rising interest rates and the rates that have already risen from last year, we're going to start to see those effects start hitting us later this year and into 2024.
Mm,
On top of that, you've got some concerns with OPEC weakening demand in
right.
oil, and China right now is very stagnant. So there's a number of signals or issues that I think we need to be concerned with.
Mhm. Meanwhile, hedge funds and many other investors made big bets on the S&P falling. There's still a lot of cash sitting on the sidelines right now. Does a defensive stance still make sense?
Well, I think having a defensive stance does make sense. I mean, the risk-free rate is above 5%. So,
Mhm.
having some money in those types of things, getting 5% short term is not a bad thing. I think with the state of the economy and the uncertainty of where things are going to end up over the next 3 to 6 months, I think having a more balanced or more defensive approach, yeah, absolutely makes sense.
And, it's worth asking because a lot of us are thinking about it. Do you think it's still possible that we will see a recession this year?
Well, I definitely think there's a possibility of that. I know we always try to look at this and say, hey, we're cautiously optimistic about things. I don't want to get too negative because there's so much good going on.
Right.
The consumer looks great. Travel's picked up, as we know. But at the same time, yeah, there's a number of things that could happen. I mean, one of the big concerns we have is the amount of credit issuance that's going on, and what the Treasury's having to do, and that's going to create a contraction in this economy. And then ultimately, how are these interest rate increases really going to impact this economy? Because we're continuing to see weakening demand across the board. So,
Mhm.
can I say we're going to be in an outright hard recession? I don't think so, but I think you can't take it off the table. I think our opinion is we're going to have more of a weaker recession, just because as we entered into this, and as we see now, the consumer still remains to be relatively strong, and they're really the backbone of our economy.
Right. So many moving parts, but Mark, it's helpful to talk through the headlines with you. If somebody is feeling anxious, though, about what they're reading and they'd like to talk it through with you, what's the best way to reach you?
Well, yeah. So if anyone would like to reach us, they can reach out, call us. Our phone number is 303-681-0113. Or you can go to our website. Actually, you can schedule an appointment there. That is McGregorWealth.com. And by the way, we're doing a number of classes
Hmm.
on retirement, income planning, and we talk a lot about the economy and how to position ourselves. So people are more than welcome to attend those as well.
So helpful. Mark, thank you.
All right. Well, thank you, Aaron. I appreciate it.